What if I told you the biggest hotel chain in the world was once drowning in debt, and a private equity firm not only saved it, but walked away with $14 billion profit? This is the unbelievable story of Blackstone and Hilton Hotels.
Back in 2007, the world economy was booming. Tourism was growing, people were traveling more than ever, and luxury hotels were printing money. Hilton Hotels was already a big global name, and Wall Street thought it was a safe, steady business. That's when Blackstone Group, one of the biggest private equity firms in the world, decided to make a bold move. Blackstone offered to buy Hilton Hotels for $26 billion. To convince Hilton's shareholders to sell, Blackstone paid $47.50 per share, which was a 40% premium over Hilton's market price at that time. A premium here means Blackstone paid 40% more than what Hilton's stock was trading at. Why? Because shareholders won't give up their stock unless they're offered something better than the market price. Hilton shareholders loved it, and the deal went through. Now, $26 billion is a huge sum. Did Blackstone really have that much cash?
No. Here's the trick. Blackstone used a method called a leveraged buyout, LBO. Blackstone itself put in around $5.6 billion of its own money, equity. The rest, about $20 billion, was borrowed from banks and lenders. But here's the twist. Once the deal was closed, Hilton itself became responsible for that $20 billion debt. I'll explain it to you. Imagine you buy a car mostly with a bank loan, but then transfer the loan to the car itself. And the car has to earn money, like by driving for Uber, to repay the debt. That's how leveraged buyouts work. So overnight, Hilton, a profitable hotel company, was now carrying a giant $20 billion debt on its books.
Just 1 year later, disaster struck. The 2008 global financial crisis hit. Travel collapsed. Business trips slowed. Hotels emptied out. Hilton's revenues plunged. But remember, Hilton still had to pay billions in interest every year on that mountain of debt. Analysts laughed at Blackstone. Newspapers called it the worst deal in history. Many predicted Hilton would go bankrupt. This is where Blackstone showed its genius. Instead of letting Hilton drown, Blackstone went back to the banks and lenders with a plan. They said, "Look, Hilton's business will recover once the economy bounces back. But right now, this debt is impossible to pay. If you force Hilton to pay at these terms, the company will go bankrupt, and you, the banks, will lose everything. So let's restructure the deal. Lower the interest, extend the repayment timeline. Give Hilton some breathing space." And because Hilton was a valuable brand, the lenders agreed. Blackstone also injected more of its own money into Hilton to strengthen it. This showed confidence and convinced lenders Hilton could survive. From 2009 to 2013, Hilton slowly rebuilt. The global economy recovered. Travel demand came back. Hilton aggressively expanded, especially in international markets like China and the Middle East. Hilton shifted its business model towards a more asset-light strategy. That is, instead of owning hotels, it focused more on franchise and management contracts, which generated stable fees without heavy cost. In 2013, Blackstone took Hilton public again through an IPO. Investors were eager to buy into the world's most famous hotel chain, now leaner and stronger.
Over the next few years, Blackstone gradually sold off its Hilton shares. By the time it fully exited in 2018, it had made about $14 billion in profit on the deal. The same deal that was once mocked as the worst ever turned into one of the most profitable private equity buyouts in history.